The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong Advisory and the advertisers heard on this program do not endorse each other or their services. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Chuck Zodda and Marc Fandetti. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. This is the Financial Exchange with Chuck Zodda and Marc Fandetti.
It's Chuck, Mark, and Tucker with you here. And we're going to kick things off talking about what went wrong in markets yesterday, because it's something that we've been touching on a little bit over the last several weeks, which is that tech stocks, specifically semiconductor stocks, and I want to focus on them because that's really where the meat of this issue is. They've just gone to a place that is dangerous for the broader market for two reasons. The first is that semiconductor stocks have just gone on this parabolic move up that, as anyone knows, whenever you see an asset go parabolically to the top side, it doesn't usually correct by just flattening out and plateauing. For evidence of this, look at what happened with precious metals at the end of last year and early this year. If anyone happens to be a silver fan, you know that silver went through this again like 3x move from the end of August through early February, and then promptly has lost 50% of its value since then. Gold likewise went through a move that saw it almost double from August to the start of February, and now has lost like 35% of its value since then. So it's just something, those are recent examples. But when assets go parabolic, they don't usually just decide to chill. And the reason why this is problematic for the broader market is because of how valuable these semiconductor companies have gotten right now. When you look at just the names that are out there that are really the problem on this front, NVIDIA is actually not the one that's the issue right now. NVIDIA has largely been out of this rally that has taken place over the first half of this year. NVIDIA entered this year at about $193 a share. It's at $199 right now. NVIDIA's up 3% this year. Now, it did have some swings in this and that, but the big moves have really been happening in the memory chip companies. Specifically, the big name that everyone's focused on is Micron Technology, which opened the year at about $300 a share and peaked at around $1,200. It went 4x in a span of 5.5 months. Other ones that are right in the crosshairs of this, SanDisk, a company that I don't think most people even knew existed before the last year because, again, they were a computer storage company that's been around for, 25 years. They're not like some hot new company that didn't IPO recently. SanDisk is a company that has been publicly traded now. Actually, no, SanDisk has only been publicly traded for a few years, but again, this is a company that I remember back in the late 90s, early 2000s as a storage company with Western Digital and Seagate and all those companies out there. And this is one where you take a look at what's happened to them this year, and they opened the year at around $230 a share. They get to $2,300 on Monday. 10x in a span of, 5.5 months. That's just not sustainable. So what you have now is this problem where these companies, again, you talk about Micron, and the issue with Micron isn't just that it's gone parabolic. It's that it's gone parabolic to the point where it is also no longer some tiny little company from a market cap perspective, but a $1.2 trillion company that can very much move the broader market. They also happen to report earnings after the bell today. And so the issue that you have here is that the movement that we're seeing in these stocks is just getting more and more violent from day to day. And eventually that's going to cause some broader problems. It hasn't yet. It's been contained. But again, you get like a day like yesterday where there's no proximate cause. It's just, you wake up and South Korean stocks, which happen to be, heavy in, the semiconductor space, are down 9%. And you're like, I guess we're just going to have a day here at this point. And this volatility is just, swirling through markets, and markets are, participants are trying to move from one place to another to try to, hold on to what they have. But it's getting a little dodgy under the surface, even though indices remain near all-time highs, Mark.
Yeah, you could describe it, backing up, as one speculative frenzy after another. Precious metals, software, chips, not software, and you could take your pick, other little segments. That's generally indicative of financial conditions that are probably a little bit too loose, and that's generally attributable to monetary policy that's too loose. I know we're going to get into that later in the show, but you brought up a lot of issues. They seem disparate, but I think they're connected, and we won't know for a while. And I think this is one of the challenges that the Fed probably faces. They're almost certainly aware of it because asset price crashes can be destabilizing to the real economy.
And the other part that we've talked about, particularly with these semiconductor stocks, these are not areas of the market that have historically been able to maintain strong margins. If you look at semiconductors historically, and I'll pull up Intel just as an example, just because, again, we got a nice long public track record. We'll go through a few of these. But if you go and look at Intel stock, and let's look at just operating margins for Intel over time, because I think this is instructive. When they went public back in the 90s, Intel had 30% operating margins that blew out in late 97. They ended up with like 55% operating margins, like just fat margins that blew out topside. By the time the tech bubble was bursting in Q4 of 2001, that 55% margin had gone down to 9. Again, just not, a very, stable space that you can play in. Other companies, when we look at, again, just other companies that operate in that semiconductor space and have, a decent track record. Let's look at Texas Instruments as another one. Again, company that's been around for a while, long track record. Okay, like show me, what things look like. Tech bubble, hey, they've got 20% margins. Tech bubble bursts, those margins go to, negative 6%. Like it's just an area that tends to get chewed up from time to time because you need a ton of capital in there, and again, it's a very boom-bust cycle. You talk about Qualcomm, another one. And I know a lot of these are older names, but I want to find ones that have been through multiple cycles that we can discuss here. Qualcomm, again, tech bubble. Hey, margins, move from, low single digits up to, 25%, and then promptly collapse, negative shortly after the tech bubble. This is just not an area of the market that tends to have solid, sustainable margins. And you see this with, how profits move for these businesses over time. Intel, which I'm still on right now, profit peaked in the tech bubble at $10.5 billion and went down to basically flat by December of 2001. It then finally got back up to, it didn't get back up to $10 billion of annual profit until September of 2010. And now Intel, through a series of missteps, hasn't been profitable for, a consistent basis since 2022. Just because, they made some bad decisions in this and that. Qualcomm, if we go and pull them up and look at, how things have moved from a profit perspective for then, yeah, it's the same thing. You had profits in the tech bubble, then you went unprofitable. They had another period where they were unprofitable in the, late 2010s. Now they've got, some profit again, but it very much is boom and bust for these companies. And this is why when you look at the Philadelphia Semiconductor Index, the moves that you see there historically might be like 2 to 4 times the moves that you see in the S&P 500 as you go through these cycles. And so it's just a dangerous part of the market to have as market leadership. I say this all with, again, the point we do have to acknowledge is, look, these stocks have absolutely kicked ass for the last, 6 months here in particular. Who's to say that they can't continue to go parabolic for, another few months? There are parts that, look very stretched here, but I'm not one to say like, oh, these are definitely going to fall apart right now, because I don't know. Greenspan gave his irrational exuberance speech, what was it, 1997?
December of more or less.
The exuberance got more irrational for the subsequent 3 years after that.
In part because of Lax maybe monetary as big a fan as I am of Greenspan, in part because of things monetary policy should have accounted for but didn't. But yeah.
So, by the way, I'm sorry that I missed the Greenspan death show. I wish I had been able to be here for that.
I wasn't here for it either.
That
was Paul Lane and Michael Armstrong.
Oh, we let them cover it?
No, it was Monday.
Oh. Well, that's fine.
Marc had his thoughts yesterday.
No, I know. It's
Did I?
Sure. Yeah.
I love Greenspan. That's the sum total of my thoughts. Flawed, of course, tenure, but a great man.
I think Greenspan actually was stronger on monetary policy than I think you would give him credit for. I think the problem that the Greenspan Fed had was on the regulatory policy side, which had a direct line to the causes of the financial crisis in terms of required capital levels for banks and things on different financial instruments. There's a direct line there in my opinion.
He's a free market libertarian, and one sympathizes. In retrospect, the approach wasn't stringent enough. In retrospect, it worked for Larry Summers too, Robert Rubin.
They trusted banks to do the
right
thing.
We all did. Nobody knew.
Yeah.
Okay, I shouldn't say nobody knew. There were plenty of critics of this approach at the time, but for several years, it was consistent with the ethos of the time. It was a heady time for free market. The 80s, the 90s, Reagan, Thatcher. Clinton was a continuation of it. I know we got a break.
No, I mean, let's continue this after, because I know it's kind of a segue, but I think it's a fun one to discuss. So let's take a quick break, and when we return, we're going to talk about, free markets winning out over communism back in the 1990s, right after this.
Find daily interviews and full shows of the Financial Exchange on our YouTube page. Subscribe to our page and get caught up on anything and everything you might have missed. This is the Financial Exchange Radio Network. Estate planning isn't just about writing a will. The right trust can help your family avoid probate, protect your home, reduce estate taxes, and even help shield assets from the cost of long-term care. That's why Cushing & Dolan created a new guide called Demystifying the Top 8 Estate Planning Trusts. Inside, you'll learn the difference between revocable and irrevocable trusts, why some trusts are designed to protect assets from a nursing home, and how certain trusts can keep your family's affairs private. The guide also explains some of the biggest mistakes families make, including creating trusts but never properly funding them. If you've been putting off estate planning, this guide is a great place to start. Call Cushing & Dolan today at 866-848-5699 to get your free copy. That's 866-848-5699, or request it online at legalexchangeshow.com. The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. One missed retirement deadline could cost you thousands of dollars. Our new guide, Understanding RMDs, breaks down the rules for required minimum distributions, including when you have to take them and what can happen if you get it wrong. This isn't just about taking money out of an account. Your RMDs may affect your tax bracket, the taxation of your Social Security, and even whether you pay higher Medicare premiums. This guide also covers common mistakes people make, like forgetting about old retirement accounts and mishandling inherited IRAs. ways. If you have money in a retirement account, this is information you need to know. Call us right now at 800-393-4001 to get your free copy of Understanding RMDs. That's 800-393-4001 or request the guide online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
In a heartbeat, you could be the difference.
Marc collapsed from cardiac arrest.
9 out of 10 people who suffer cardiac arrest outside the hospital don't survive.
It took 30 minutes of chest compressions to finally feel a pulse.
Most of the time, it's because no one nearby performs CPR. But together, we can change that. Extraordinary things happen when people take action. A small step, a simple skill, a life-saving moment. HeartWalk brings communities together to create health and hope for every heartbeat. Every walker who joins HeartWalk, every dollar donated, means more people trained in CPR, more research, and more life-saving moments for everyone. Take the first step and register for your local HeartWalk. Extraordinary starts with you. Join HeartWalk today. Find your local HeartWalk at heartwalk.org.
Let's talk LDL. AKA bad cholesterol. The higher your LDL cholesterol, the higher your risk of a heart attack or stroke. Your health matters. Know your number. Talk to your doctor and get your cholesterol checked. And learn how to help lower your LDL bad cholesterol. Because your health is in your hands. Find out more at heart.org/LDL.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
Missed one of our shows? Catch up anytime by asking your Alexa smart speaker to play The Financial Exchange. This is the Financial Exchange Radio Network.
All right, so we started the last segment talking about semiconductor stocks and somehow ended up talking about the victory of capitalism over communism in the 1990s. That's how you know you've had a great segment and are also approaching the 4th of July. In any case, one of the things that we were touching on was the Greenspan Fed and basically where the Greenspan Fed had things right and where the Greenspan Fed had things wrong and how it fits into that broader conversation of, free market economics and why they might have made the mistakes that they made. You, I know, had a decent chunk that you wanted to get through before we had to go to break, so I'm going to let you kind of.
No, I don't have a lecture. I just wanted to point out that it's easy to judge Greenspan in retrospect. The intellectual climate, of course, it always is. It's easy to judge Burns, the Fed chair during most of the 70s, in retrospect. When we talk about the 70s and the 90s, we use anachronisms. We talk about potential GDP. We talk about non-inflationary unemployment. All this word salad of technical terms that monetary policy experts use today, but that weren't in use then, that indeed weren't even known then. Had we known now, this is trite, but had we known now what we knew, had we known in the 90s or the 70s what we know today, the 70s or the 90s would not have happened. And conversely, if they had not happened, we wouldn't know now what we do know now. We know because we made mistakes. Greenspan, I think he was a great man, and it's not hyperbole, because he had integrity, independence. He had beliefs, but he was flexible. I like him because he was conservative/libertarian, the philosophy that I eventually, adopted, and one that we've sadly thrown out the window. No one represents it anymore. Maybe Rand Paul and people like that. But Greenspan was nimble. He didn't follow, you hear the term, and we'll probably use it today, reaction function. In the literature, that just means a rule. If I see X, I do Y.
Sure.
Input X plus 1, I do Y plus 1. Or whatever the reaction, whatever the rule is. It's just a function like you learned in algebra. That's all. So Greenspan didn't have a rigid reaction function. He sometimes gets criticized for that. Well, he didn't follow the Taylor rule. Here, he did follow it there. He gets criticized from a regulatory leniency point of view that almost certainly did exacerbate the housing bubble and contribute to the Great Recession. And there were people at the time who criticized him for being too lax. But it also appeared to be working. And I say again, the intellectual climate at the time was one of sort of permissiveness. Set the rules of the game and then let business do what it'll do. Somehow that morphed into bailing everybody out and using. So his. Go ahead, please, because I've talked enough.
I do wonder. No, it's interesting. I wonder, Greenspan left the Fed in 2006, 2 years before everything blew up.
Right.
And I have wondered how a Greenspan-led Fed would have approached the financial crisis and whether it would have been different from a Bernanke-led Fed. Because it was Bernanke and Paulson who were basically,
right.
controlling things at that point. And we'll never know because he wasn't, Greenspan wasn't there at that point. But I think that you can draw a direct line to, what we saw in the fall of 2008 and say that many of the problems that plague us today on the corporate side of things in terms of corporate concentration and, government support for companies, you can draw a direct line to the events 18 years ago and say it sprang from that. Because those were things that were not present during either of the recessions that happened on Greenspan's watch.
Bernanke's seminal work in the early 80s was on the transmission of banking, financial and banking crises to the real economy.
Yeah.
So I think Bernanke, my guess is Greenspan, and monetary policy scholars could give you a better opinion on this, but I'm all you've got here. Bernanke probably worried about another Great Depression because he was a Great Depression and banking crisis scholar.
Yeah.
He probably introduced way more tools than Greenspan would have. Would Greenspan have kept Fed funds as low as Bernanke did for as long? Maybe. He did do that in the early 2000s. He lowered Fed funds to 1 and left them there, arguably for too long. Would Greenspan have introduced an inflation target, an explicit one? Almost certainly no, because he was prodded to and he resisted.
Right.
Because he wanted the flexibility. Think
Right.
pragmatist.
He wanted to be his,
He liked being a little Sphinx-like, a little mysterious.
He wanted the opportunity to choose, what to be done at what particular time.
Yeah. Would he have introduced forward guidance, something we've now jettisoned? Probably not. Useful we'll talk about this.
Sure.
We're going to talk about Bill Dudley's piece, but useful in some circumstances, but it's been abused, and Warsh is correctly, I think, tabling it. So my guess is we wouldn't have this is really speculative, but I'll say it. And it's not going to offend anybody. My guess is we wouldn't have some of the problems we have today, the massive balance sheet, the confusion over Fed messaging, the incoherent forward guidance, which you then commit to and it then prevents you from doing the right thing, like it tied Jay Powell's hands. We wouldn't have some of these problems had someone more like, as much as I admire Ben Bernanke, by the way, nothing against him, my guess is we wouldn't have some of the problems we have today if we had someone more like Greenspan.
So that's I think that's a good Greenspan wrap up now. Let's take a quick break here. And when we return, let's talk about something a little bit more current. We're going to talk about SpaceX, just because that is
not 25 years ago.
Very current now. And so we're going to do that when we return.
Like us on Facebook and follow us on Twitter @TFE Show. Breaking business news is always first, right here on the Financial Exchange Radio Network. Without the right estate plan, your family could face unnecessary costs in the future. The right trust may help your loved ones avoid probate and better protect family assets. Get Cushing & Dolan's new guide called Demystifying the Top 8 Estate Planning Trusts by calling 866-848-5699. That's 866-848-5699. Or request it online at LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated. affiliated.
This is Michael Valila, adjutant of the Disabled American Veterans Department of Massachusetts. The DAV of Massachusetts has helped me and countless others adjust to civilian life through a variety of incredible programs. Through our local Veterans Assistance Program, we provide necessary services to veterans and their communities, such as food shopping, landscaping, and companionship, but we need your support. You can help by making a donation today. Please visit dav5k.boston. That's dav5k.boston.
9 out of 10 people who suffer cardiac arrest outside the hospital don't survive. Most of the time, it's because no one nearby performs CPR. Every walker who joins HeartWalk means more people trained in CPR, more research, and more life-saving moments for everyone. Take the first step and register for your local HeartWalk. Extraordinary starts with you. Find your local HeartWalk at heartwalk.org.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. One missed retirement deadline could cost you thousands of dollars. Our new guide, Understanding RMDs, breaks down the rules for required minimum distributions, including when you have to take them and what can happen if you get it wrong. This isn't just about taking money out of an account. Your RMDs may affect your tax bracket, the taxation of your Social Security, and even whether you pay higher Medicare premiums. This guide also covers common mistakes people make, like forgetting about old retirement accounts and mishandling inherited IRAs. If you have money in a retirement account, this is information you need to know. Call us right now at 800-393-4001 to get your free copy of Understanding RMDs. That's 800-393-4001 or request the guide online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Our Senators Edward Markey and Elizabeth Warren and Representative Ayanna Pressley are standing up for radio listeners like us by supporting legislation to keep AM radio in cars. They know the value of local radio in times of emergency. Now it's time for Congress to finish the job and pass the AM Radio for Every Vehicle Act. Learn more at dependonam.com. This message furnished by the National Association of Broadcasters and this station.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutzke from the law firm of Cushing & Dolan with your Financial Exchange Quick Tip of the Day. And today we're talking about your new guide, Todd, Demystifying the Top 7 Estate Planning Trusts. If there are younger families out there, should they consider having a trust in place, and what type?
Most people don't think about it when you're young, but if you're a young family, meaning you've got minor children, you might not have a ton of assets yet, but you want to make sure that what you do have is protected for your children. You could probably use a revocable trust. I don't think you need an irrevocable trust, but a revocable trust. You put your assets in. Again, they're going to avoid probate. Again, it may or may not be a big estate tax issue at the moment, but whatever you have, your children can't own, right? They are minors. So you don't necessarily want to leave your assets to a guardian and have the guardian deal with everything when you can design a trust to hold the assets and ensure how and when and where and why they get these assets. Just pick the right trustee, put the language you need in the trust to control it for those children, and the trust will accomplish that task. So just because you're young, folks, doesn't mean you shouldn't think about your estate planning. Sometimes it's not all about the money and the probate and the taxes, but more so about the family behind the estate plan.
The estate planning experts at Cushing & Dolan have been helping families like yours for more than 30 years, and they have written a brand new guide called Demystifying the Top 7 Estate Planning Trusts. Call right now for your free copy, 866-848-5699. That's 866-848-5699. Or you can request it from their website, legalexchangeshow.com.
The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Armstrong do not endorse each other and are not affiliated. Time now for Wall Street Watch, tracking the stocks, the data, and the headlines driving markets so far today, right here on the Financial Exchange Radio Network.
Tech is seeing a modest rebound after its recent sell-off. Right now, the Dow is up over 0.4%. S&P 500 also up over 0.4%. Nasdaq up about 0.5% or 130 points higher. Russell 2000 is up modestly about 0.2%. 10-year Treasury yield pulling back 7 basis points at 4.41%. And oil pulling back 4% now, trading at $70 a barrel. In its first earnings report since it went public in May, Cerebras said it expects its operating margins to remain negative and under pressure through the end of the year. Shares in the chipmaker sinking by 15%. Meanwhile, FedEx logged higher revenue in the previous quarter, but the shipping company's profit ticked lower. That stock is down by 1%. Elsewhere, fast food burger chain Wendy's seeing its stock surge nearly 30%, driven by meme stock retail investors after the company disclosed new management changes. Trading was actually halted on the stock earlier today. Alphabet will replace Verizon in the Dow Jones Industrial Average ahead of Monday's trading. Alphabet shares are up by 1%. Home builder KB Home posted mixed quarterly results, but the stock rallying 16%. And after today's close, we'll see more tech earnings when chipmaker Micron Technology reports. Yesterday, the stock plunged 13% ahead of its earnings, but is mostly flat today. I'm Tucker Silva, and that is Wall Street Watch.
Got a piece in Bloomberg here. Musk's SpaceX adds billions in debt while cutting interest costs. And I had someone ask me yesterday, they were like, okay, so SpaceX just went public and raised, like $80 billion. Why do they need to go and, do a debt offering for $20+ billion as well? And I had a few thoughts on it. There's 3 reasons in my mind that SpaceX is doing this. I'm curious to get your thoughts too. Number 1, as indicated by this piece, they are retiring some debt from X and XAI that had a higher interest rate. So this is going to save SpaceX about $300 million a year in interest costs. That's number 1. Number 2, I think that given the fact that SpaceX is now publicly traded and there's a lot of interest there, it gives SpaceX the ability to go and do this investment-grade bond issuance and almost kind of start to build credit in public markets by being able to say, hey, we've done this bond issue previously, here's how it went off, here's how the bonds trade, such that if they need to tap capital markets in the future, they have a track record that they can point to. Okay, maybe it's there. Point number 3, kind of related to that, hey, you just had this huge offering on the equity side. If you have a business that is losing money on an annual basis and everyone is still excited about you and willing to throw money at you, hey, why not take time to go and raise more money and strike while the iron's hot? Your thoughts?
I was going to say strike while the iron's hot. That to me, there may be some financial engineering minutia, and by that I mean like what you said, effectively retire old debt, replace it with lower interest rate debt. It's like refinancing your mortgage. I'm not sure I buy that because the savings are a pittance, but maybe. What do I know? It's more likely that they are exploiting the favorable capital market conditions and raising as much capital. Look, people don't care how Elon spends money. I think that's proven.
Sure.
They just trust that he will spend it well.
Yes.
Yeah. So, why not? We may want to buy another AI company. Why not put another $100 billion in the kitty and see what happens while markets are welcoming?
So I think that ultimately this probably is not probably. I would be shocked if this is not the last bond issue that comes from SpaceX, just because, again, they are losing money. They have a bunch of CapEx they're going to need to do the next several years, and very likely that they have to issue another tranche of bonds at some point during that time. But this also ties into, hey, we've seen a bunch of other data center companies issuing both debt and equity in the last few weeks as well, whether you're talking Amazon, Google, you can go down the list. And so this fits in what those other companies that they're trying to compete with in that exact space are doing as well. They're all seeing the same thing right now.
Michael Armstrong made the point yesterday that SpaceX is, and these are my words, not his, effectively too big to fail, so why not give them an investment grade rating? They're almost systemically important given their market cap and the relationship between capital markets and the real economy that we talked about in the last segment. And they're the only virtually the only company that can competently launch satellites. So the government is uniquely dependent on them. So Mike's point, and this is the way I interpreted it. He may disagree with the finer. My fine tuning of it is that they're too big to fail. So yeah, slap an investment grade rating. There's very little risk there.
Well, the other piece is if you're looking to the ratings agencies to tell you when there's a problem, you're looking to the wrong people. The ratings agencies are notoriously slow when things start actually deteriorating. Like, you don't look at a bond's rating to tell you if there's a problem. They'll tell you after the problem has become apparent that, oh, there's a problem. But ratings, I mean, look at the run-up to the financial crisis.
Yeah, they had some big misses. On average, they're decent, but they had some big misses,
They're fine in general. Like,
on average.
It's not to disparage them, but like they are never going to move in advance of problems showing up.
Yeah, and you wouldn't expect
that's not what they do.
You wouldn't expect them to have information, by the way, that private investors didn't. It's not like they're the only ones out there scrutinizing the ability to pay interest and repay principal.
Correct. And so, like, the first place that you look to see if there are problems is, hey, how have these bonds been trading recently? That will move in advance of a downgrade happening.
Absolutely.
Let's talk a little bit more about the Warsh Fed. We got a piece from Bill Dudley, who used to be a Fed Reserve Bank president. He ran the New York branch for a number of years. And he's got a piece in Bloomberg Opinion today titled, Warsh's Pivot Risks Confusing the Market and the Fed. What exactly does he outline in terms of how Warsh's pivot, what is Warsh's pivot and how can it be confusing?
Well, he's abandoned, sorry, I read this much earlier today, so this is going to be a little bit out of order. But I remember my gut reaction, which is Dudley's being too harsh on Warsh, who I thought did a very good job of focusing on price stability, which, despite the dual mandate, is what most people expect the Fed to do, deliver low and stable inflation. Whether it's 2% or 3% is almost hair-splitting. Just keep it in the background. I don't want to think about it. So I thought, let me first say, I think we should all acknowledge that Warsh did a really good job of demonstrating credit. You could tell I like him.
Sure.
And I'm willing to give him the benefit of the doubt. So Dudley is somewhat critical of the, he wasn't really critical, but he pointed out that we abandoned forward guidance without a replacement or something to that effect. Dudley also points out that forward guidance is useful at the zero lower bound, meaning you can't lower interest rates anymore, so you start to jawbone longer-term rates lower. But we haven't been in an environment like that for a long time, so good riddance for now for forward guidance. Abandoning he talks about the reaction function, a fancy academic way of saying the rule I follow when I see you do something, I react in this way. That's all a reaction function is. It's my action as a function of your action. If you can picture that as a little two-dimensional plot, that's all it is. Just call it a rule. I have no idea why we have to call it a reaction function. Anyway, he wouldn't tell the media his reaction function. A little bit Greenspan-esque. Maybe I'll react harshly. It depends on why inflation's going up and what financial conditions are and where equity prices are. I don't have a fixed reaction function. Warsh didn't put it that way. I wish he had. I think that's how he feels, though.
And I think the big thing for markets now, and this is going to take probably 12 to 18 months for them to sort through, is they're going to need to understand and figure out, okay, what are the things that we need to care about and what are the things that we don't?
Right.
And I think that it's ultimately going to be something where markets and us, like everyone then,
we are markets,
will judge Warsh based on if Warsh is saying, hey, I'm not going to tell you as much, but I'm going to do what I need to do, well, then Warsh is going to have to prove to markets that he will do what he needs to do.
Yeah.
Warsh is asking to be judged by his actions, not by, well, the forward guidance will do it for me, so I don't need to act.
I agree with that. I actually think his credibility demonstrated by a willingness to squash inflation despite the economic costs, and he's not yet proven he will do that, but I think he's got the mettle. You could tell I'm in a honeymoon stage with Warsh. He came in as Trump's toady, but I don't think he's going to be Trump's stooge. I don't know how long Trump's going to put. I'm sorry to bring up the president and offend anybody who loves him, but go ahead, Troy.
No, it's ultimately going to be, hey, Warsh's press conference, the only side of the mandate that he mentioned was price stability.
Loved it.
He basically didn't mention
Loved it.
unemployment
Loved
during
it.
the entire time.
Yes.
Now markets are going to say, okay, show me that you are serious about price
Probably,
stability
yeah.
because for the last 5 years, we've had inflation running north of 2%, and not modestly north of 2%.
Chuck, we've already had inflation north of 2% in the first 5 months of this year.
Yes. So what markets
Yes,
are
Mark,
going
thank
to
you.
do is they're going to say, okay, you know what? Gas prices are coming down over the next couple months. So you've got a pause because you're going to see some good headline inflation numbers the next couple months. But we've got core inflation right now, depending on whether you want to look at, CPI or PCE. We've got core inflation on CPI right now coming in at 2.8 and rising. Core PCEs at 3.3 and rising. If we get to September and we've got those at, 3.2 and 3.5, it's going to be a tougher putt then for the Fed to be able to say, you know what, we're not doing anything, and maintain the credibility there, because the credibility now is going to be based on action, not based on speech.
Yeah, I mean, it depends on what else is going on in the real economy at that point, but...
It will.
Look, go ahead.
But, let's be honest. The two parts of the real economy that we worry about, at least over, any reasonable, period of time that, recently. Housing, showing signs of life now. Labor, showing signs of life now. What else? What in the next 3 to 4 months? What breaks in the U.S. economy?
Well, I don't know. Maybe something does. In which case, Warsh will react. I assume.
The only thing, in my opinion, that could possibly break in the next few months is if something goes haywire in the Middle East and oil prices move back up again. And that's not a cutting scenario.
Maybe. Or asset prices crash, and that translates into a retrenchment in demand like we saw in, earlier periods. I mean, I don't know what shocks could hit the real economy. Dudley also makes the point, it just hit me, that markets, an important monetary transmission channel, the way the Fed affects the economy, it's by lowering interest rates, of course. Stimulates demand, sure, but also stimulates asset prices. Dudley is of that school. I don't like that school at all. I'm tired of the Fed trying to manipulate. It is an important transmission channel. I certainly don't deny that. Empirically, you'd be a fool to deny that. It's widely accepted. But constantly catering to markets, as Bernanke, as much as I admire Bernanke, and Greenspan was a little bit guilty of this too, they were obsessed with keeping markets aloft.
Bernanke, I think, felt that he had to because...
Understandable.
Bernanke I can actually understand because the post-2009 economy was so putrid for 4 to 5 years.
It was rough.
And there was no help coming on the fiscal side. The fiscal side was moving in the other direction.
Eventually, yeah.
That's you got a tiny little, the
at the time it was big.
It was relatively small and a slow. What was it called? The I'm blanking. The ARRA, the American Recovery and Reinvestment and Recovery Act, or whatever it was. But it was just a slow program that, again, you could see it with the economy. I mean, the economy was really bad for basically from 2008 through 2013, 2014.
No, it was ugly for a while,
things were bad. And so I think Bernanke kind of looked at it and was like, okay, there's no help coming. Europe is going through, pretty harsh austerity measures. The U.S. is not, we're not really doing anything fiscally to help and give, a real boost there either. The problem that we've ended up in is we've kind of just said, okay, we didn't do enough then, but now we're just going to have perpetually higher deficits, and you still have monetary policy acting like it's 2009, 2010 in a lot of respects. Let's take a quick break. When we return, let's see. Let's talk a little bit about housing when we return.
Remember, you can watch the show live every day on our YouTube page. We've got market updates and breaking business news all morning long, plus a full archive of all our show's content. It's all there with the click of a button at youtube.com/The Financial Exchange Show.
This is Susan Powers from the Armstrong Advisory Group. When it comes to Social Security and Medicare, the decisions you make today can have a lasting impact on your retirement. There are key choices to consider, like when to claim, how spousal and survivor options work, and whether your Medicare coverage is aligned with your needs. Without a clear strategy, it's easy to overlook how taxes, income, and healthcare costs all connect. Join us for a complimentary educational seminar on Thursday, June 25th at 5 p.m. at the Marriott in Quincy. We'll help you understand your options and the decisions that come with them. That's Thursday, June 25th at 5 p.m. at the Marriott in Quincy. Reserve your seat today by calling 800-393-4001. That's 800-393-4001 or register online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Without the right estate plan, your family could face unnecessary costs in the future. The right trust may help your loved ones avoid probate and better protect family assets. Get Cushing & Dolan's new guide called Demystifying the Top 8 Estate Planning Trusts by calling 866-848-5699. That's 866-848-5699 or request it online at legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated. Every mile can make a difference for a Massachusetts veteran. The DAV 5K Boston returns to Castle Island on Saturday, November 7th for a family-friendly day of community, remembrance, and support. Whether you run the 5K, join the 1 mile walk, or make a donation, your participation helps further the mission of the Disabled American Veterans Department of Massachusetts. Honor those who served. Sign up today at dav5k.boston. That's dav5k.boston.
Our Senators Edward Markey and Elizabeth Warren and Representative Stephen Lynch are standing up for radio listeners like us by supporting legislation to keep AM radio in cars. They know the value of local radio in times of emergency. Now it's time for Congress to finish the job and pass the AM Radio for Every Vehicle Act. Learn more at dependonam.com. This message furnished by the National Association of Broadcasters and this station.
As a busy mom to 4 kids, my to-do list is full.
Trying to fit in exercise, eating right, and prioritizing self-care can feel next to impossible.
While we can't add more hours to the day, we do have a great resource to help.
Go Red for Women has easy tips, tools, and information to help you and your family live a healthier life.
So to all the moms, the aunts, grandmothers, and amazing women out there doing it all,
visit goredforwomen.org/momlife today.
You take care of them, Go Red for Women will take care of you.
When a heart stops, the clock starts. You are the first responder until help arrives. In that moment, 4 minutes equals brain damage. 6 minutes equals too late in an emergency. The first responder is you. We need you. Will you be ready? Learn CPR. Visit heart.org/nation. That's heart.org/nation.
Is it a stroke? Even if you're not sure, act fast and call 911. Signs can include face drooping on one side, arm weakness, speech difficulty, or not making sense when talking. Time is critical. A stroke requires immediate medical care, which starts as soon as the ambulance arrives. So if you see any sign of stroke, act fast and call 911. Visit mass.gov/stroke, sponsored by the Massachusetts Department of Public Health.
Breaking business and financial news first throughout the day. Only here on the Financial Exchange Radio Network.
We got a piece here in the Wall Street Journal. It's titled, "Brief Drop in Mortgage Rates Points to Another False Start for the Housing Market." I'll quote here, "The U.S. mortgage market is locked in a tug of war, leaving home buyers and refinancers caught between a brief respite in geopolitical tensions and a hawkish Federal Reserve. In late February, driven by Fed cuts in prior months, the 30-year fixed-rate mortgage drifted below 6% for the first time since 2022. But the celebration was short-lived. Joint military actions by the U.S. and Israel against Iran ignited a war that spiked oil prices and stoked inflation." with news of a new ceasefire agreement, though, the average mortgage rate trimmed back to 6.47% last week, but that decrease looks fragile. And I got to be honest, I don't have a dog in the fight. I'm not shopping for a house right now. I don't know not the ceasefire. I don't know that you can definitively say that where mortgage rates stand right now look fragile. I think that ultimately they are a function of where long-term interest rates tend to move, and being able to predict long-term interest rates and how they're going to move over any short period of time is often a coin flip. It's not something where you can definitively say they're going to do this or that. Heck, just today, when I woke up, the 10-year Treasury was pretty much flat at 4.48%. And for whatever reason, I don't know why, I don't see any news that would move it in this fashion, but the 10-year has basically slid 9 basis points since 8 a.m. I haven't seen any news that would move it in that fashion.
The disinflationary impact of falling energy prices, obviously, and maybe
but that's been in place for
I know.
Again.
But sometimes it takes things a while to crystallize, though.
I don't know. I mean, you look at how things have moved the last 2-3 weeks.
I agree. It seems abrupt.
You've had energy prices falling, and rates have decoupled from energy prices during that time. I try to look for cross-asset signals to tell me what's going on. The message this morning is a weird one. Like, it doesn't make a ton of sense. You've got falling interest rates. 10-year Treasury is seeing its, almost a 10 basis point decrease. On that, okay, you've got oil prices falling as well. Sure, that can make some sense. Tell me why gold's getting whacked by 3% today.
Because real rates may rise under a Fed more committed to fighting inflation than people thought. I know we knew that last week. And asset prices in real time don't all have to move in a macroeconomically consistent manner. There's nothing that says that they do. So you don't need one explanation for everything. This isn't like a
No, but when
quiz.
those correlations break down, it's interesting.
Yeah, I mean, they don't over short-term periods. They tend to be very unstable. I'm not disagreeing with you. It's curious and it's notable and worth talking about. But I'm not. My worldview isn't upended because this zigged when it should zag in response to what something else did. Short-term correlations
I'm not saying anything's upended, but it's strange to see, okay, you got dollar down, oil down. I'm sorry, 10-year down, oil down, but dollar up and gold down? Like, that's different. And I'm just noting that it's different, not that it's the end of the world. It's not. The world's still here. It's fine. It's pretty good. You should try it sometime, everyone. Let's take a break. When we return, let's talk a little bit about some other stuff.
I was 24 when I had a stroke.
I was 35 when I suffered a heart attack.
I was 46.
I was 62.
It's a fact. Cardiovascular disease is the leading cause of death in women.
But we can fight against our number one killer.
Talk to your doctor about your risk factors.
Know your family history.
Learn the warning signs and symptoms.
Together,
let's go red for women.
Visit goredforwomen.org to learn more.
Let's talk LDL. AKA bad cholesterol. The higher your LDL cholesterol, the higher your risk of a heart attack or stroke. Your health matters. Know your number. Talk to your doctor and get your cholesterol checked. And learn how to help lower your LDL bad cholesterol. Because your health is in your hands. Find out more at heart.org/LDL.
Without the right estate plan, your family could face unnecessary costs in the future. The right trust may help your loved ones avoid probate and better protect family assets. Get Cushing & Dolan's new guide called Demystifying the Top 8 Estate Planning Trusts by calling 866-848-5699. That's 866-848-5699. Or request it online at LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
This is Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. The DAV of Massachusetts has helped me and countless others adjust to civilian life through a variety of incredible programs. Through our local Veterans Assistance Program, we provide necessary services to veterans and their communities, such as food shopping, landscaping, and companionship, but we need your support. You can help by making a donation today. please visit dav5k.boston. That's dav5k.boston.
In a heartbeat, you could be the difference.
Marc collapsed from cardiac arrest.
9 out of 10 people who suffer cardiac arrest outside the hospital don't survive.
It took 30 minutes of chest compressions to finally feel a pulse.
Most of the time, it's because no one nearby performs CPR. But together, we can change that. Extraordinary things happen when people take action. A small step, a simple skill, a life-saving moment. HeartWalk brings communities together to create health and hope for every heartbeat. Every walker who joins HeartWalk, every dollar donated, means more people trained in CPR, more research, and more life-saving moments for everyone. Take the first step and register for your local HeartWalk. Extraordinary starts with you. Join HeartWalk today. Find your local HeartWalk at heartwalk.org.
This is the Money Matters Radio Network, WBNW 1120 AM and W275 CM FM, Concord, Boston. The Money Matters Radio Network. Every mile can make a difference for a Massachusetts veteran. The DAV 5K Boston returns to Castle Island on Saturday, November 7th for a family-friendly day of community, remembrance, and support. Whether you run the 5K, join the 1 mile walk, or make a donation, your participation helps further the mission of the Disabled American Veterans Department of Massachusetts. Honor those who served. Sign up today at dav5k.boston. That's dav5k.boston.
Our Senators Edward Markey and Elizabeth Warren and Representative Jake Auchincloss are standing up for radio listeners like us by supporting legislation to keep AM radio in cars. They know the value of local radio in times of emergency. Now it's time for Congress to finish the job and pass the AM Radio for Every Vehicle Act. Learn more at dependonam.com. This message furnished by the National Association of Broadcasters and this station.
A trust can do a lot more than simply pass assets to your family. Certain trusts may help keep your estate out of probate, protect assets for your children, and in some cases, even help reduce estate tax liability. Cushing & Dolan has created a new guide called Demystifying the Top Estate Planning Trusts. It breaks down some of the most commonly used trusts in estate planning, including trusts designed to help families plan for long-term care, protect beneficiaries with special needs, and help keep life insurance proceeds outside of a taxable estate. You'll also learn why simply having a trust isn't enough, because if it isn't properly funded, it may not accomplish the goals you expect. To get your free copy, call Cushing & Dolan today at 866-848-5699. That's 866-848-5699, or request the guide online at legalexchangeshow.com. The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and/or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
This is Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. The DAV of Massachusetts has helped me and countless others adjust to civilian life through a variety of incredible programs. Through our local Veterans Assistance Program, we provide necessary services to veterans and their communities, such as food shopping, landscaping, and companionship, but we need your support. You can help by making a donation today. Please visit dav5k.boston. That's dav5k.boston.
9 out of 10 people who suffer cardiac arrest outside the hospital don't survive. Most of the time, it's because no one nearby performs CPR. Every walker who joins HeartWalk means more people trained in CPR, more research, and more life-saving moments for everyone. Take the first step and register for your local HeartWalk. Extraordinary starts with you. Find your local HeartWalk at heartwalk.org.
Hi, this is Chuck and Mike from the Armstrong Advisory Group. We've got a guide available this month on required minimum distributions. And, Mike, I want to talk about common mistakes that we see. Sure. Let's start first. People not understanding the difference between inherited and non-inherited IRAs.
Yeah, so if you've ever inherited an account that is retirement in nature, you've dealt with these complicated rules. And to make it more complicated, the rules have changed over the last several years. But suffice to say, unless you meet some very specific scenarios, in most cases, if you inherited an account from a non-spouse, then you're going to have 10 years to empty that account, pay any of the taxes that are due on it, and move along. But in addition, there are annual required minimum distributions, and it is very complicated.
What about a situation where someone tries to delay taking their RMD? What kind of problems can you run into there?
Well, one, if you delay your first year RMD, then you're going to have to take 2 in the same year, and that can really add to the tax burden. But more generally, if you just wait to deal with your future RMDs until you're 73 or 75 years old, you just have fewer options. It's going to bump up your income. You may end up paying higher taxes. You may end up paying higher Medicare premiums. Your Social Security could become more taxable. So it pays to plan early when it comes to RMDs.
Our guide this month is titled Understanding RMDs, and there are 2 different ways you can request it. The first, you can go to armstrongadvisory.com and request it there. The second, call 800-393-4001. That number again is 800-393-4001, or request it at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong Advisory and the advertisers heard on this program do not endorse each other or their services. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Chuck Zodda and Marc Fandetti. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. This is the Financial Exchange with Chuck Zodda and Marc Fandetti.
Chuck, Mark, and Tucker with you here. And as we kick things off this hour, we got stocks making a rally. And if you like stocks going up, then you'll like today better than yesterday, because yesterday was not great. I'd prefer not to do that again. Today, good. You've got the S&P up 53 points. That's fun. You've got the Dow Jones Industrial Average up 416 points. Also fun. And the NASDAQ Composite's up 214 points. That is fun, too. Even that cute little Russell 2000. Yeah, who's a good boy? Yeah, you are. Yeah, you're up 28 points, which, again, no one knows what that means for the Russell 2000. It's about 1%. So we've got stocks rallying across all major U.S. indices. Great. Bonds also rallying. 10-year Treasury down 8.7 basis points to 4.406%. Again, not really seeing any news that's driving this today, but it is moving in that fashion. Dollar index, despite rates down, dollar up. So you remember last spring when everyone was freaking out because it was rates up, dollar down? That's what you don't want to see with a currency. This is the opposite. This is what you want to see, which is rates down, dollar up. That is fantastic. Dollar's up 0.31% to 101,485. Let's see. We got gold. On that dollar strength, gold is continuing to get just bludgeoned. And again, it's just been like relentless for gold in the last couple months now. Down another $125 an ounce to 4,023. And we've got crude oil, West Texas Intermediate, sliding another $327 a barrel. Down below 70 a barrel for the first time in almost 4 months. You're at $69.94. Obviously still above the 55 to 60 range that we were at pre-war, but got to be honest, it's come down a lot quicker than I was anticipating. You do have these flows exiting Hormuz now that are trying to find buyers. I think the question still is, okay, what does the back half of the summer look like after these ships escape Hormuz that were preloaded? Do you have enough flow coming back in to continue moving at this pace? We'll see what we get, but thus far, things moving really well on the crude oil side. AAA national average for gas prices, stagnant overnight though. Up actually 0.2 cents to 3.92 and 0.8. part of this, so when we talk about gas prices, there's two different factors. The first is, okay, what's the price of crude? The second is, what's the demand for gasoline? And then by virtue of that, what is what's called the crack spread that you get from refiners? Cracking is the process by which refiners basically turn crude oil into the various different products. The crack spread represents, hey, how much of a premium are they able to charge for the product versus the input price on the crude? And what's been interesting to watch in the last couple weeks, as crude prices have come down, crack spreads have moved up topside again. Cracks are still very wide right now, around $50, $55 a barrel. Typical crack spread usually is somewhere in the 20s, so you still have those very much elevated right now, and at least for, this one day, maybe that's a factor in keeping gas prices from falling further, but I still think you have some room for gas prices to move down into that 350 to 360 range. Not pre-war. Remember, we were at, 288, but still a lot better than 450. We'll take 350 over 450 any day of the week, and maybe even twice on Sunday. That sounds lovely. So, let's talk more about oil. Got a piece from Bloomberg. Oil falls below, it says 75 a barrel, but we should cross that out because it's below 70 now. You've got oil below 70, and here's what you're seeing. There has been an uptick in ships exiting the Gulf carrying oil. The two things that you want to watch are what ships are exiting and what's the flow coming back in of empty tankers known as ballast tankers. Here's the couple of things that we're seeing. Number one, to this point, the heaviest volume of crude tankers coming out has been Iranian affiliated. And so that is, I think, something that is worth watching just because it's clear that Iran is, managing the flow right now to get their tankers out. Do you see a suitable uptick of non-Iranian affiliated tankers in the near future? The other piece is you need a suitable flow coming back in of other new tankers. And this is being held up in a couple of different areas in terms of, okay, again, which ships are able to get through. But the other issue that is coming into focus on this is price, where, again, I've seen, the various numbers on this. Tanker costs in order to go back into Hormuz are running anywhere from 4 to 9x their pre-war costs, simply because the fleets that are willing to go back in right now, they don't want to get stuck there, and if they are going to get stuck there, they want to get paid. So when you talk about this in terms of dollar value, normally the transport of oil from the Middle East to anywhere else adds about $1 to $1.50 a barrel onto the cost of it. Like when you look at like the cost of buying that barrel, that's what it works out to. When you're talking about, 4 to 9x, now you're talking like $5 to $10 per barrel is the added cost with that type of price attached to it. Hey, eventually if enough companies, say, okay, like we're going to go back in, then you get competition and it drives those costs down. Right now, the only companies that are willing to go back in are the ones that are, willing to take on higher risk. Maersk has said, hey, they're not making any changes to operations right now, just as an example. Maersk is more on the container ship side of things, but, just to be representative of what's going on, not every company is comfortable taking the same level of risk. And the way that I had it explained yesterday, which I think, really gets at it, is, hey, before the Strait of Hormuz was closed, it was this theoretical risk that, yeah, you had to consider it, but you never had to really price. Now that you know it can happen, it is something that you want to build into your pricing structure, and so that should be reflected in, basically a risk premium for the cost of transiting Hormuz going forward. So I find it all interesting in terms of where we are, but still there's enough oil coming out at the moment that short-term prices are moving down. The question is still going to be, what do things look like over the remainder of the summer? Because you can't continue at this pace of exits if you don't have entries coming in suitable quantities. And right now there still is a mismatch on that side.
Yeah, the key point, you've already made it, is that oil prices will be somewhat higher globally going forward because of this. Period.
Not $100 or $120. Like if everything goes fine, like you won't get there.
I don't think so, but it's like once there's once a government defaults, it's stigmatized.
Yes.
Their borrowing costs are higher in perpetuity. Similarly, Iran has proven they can do this when pushed. That risk has to be priced into oil. I don't know if it's 1, 3, 5, or 10%. I don't know if we'll ever be able to tease that out empirically. I'm sure researchers are already working on it. But they're going to be higher, as you've pointed out.
So this, I think, the place that I land is based on the flows coming out right now. Oil prices should stay in a pretty good spot over the next 6 to 8 weeks as long as there's no further disruption. The question is going to be, again, back half of the summer now, what do things look like? And that's going to be dependent on the flows coming in of empty tankers over that same time period and what kind of production can get spooled up. We've gone from around 12 million barrels a day of production being offline to around 8 million being offline. That still represents a real problem if you can't get that back online, but we don't know that that's going to be the case. So we'll see how things move. My expectation, prices down, maybe prices up a little bit. And then, again, after this, look, those of you who've listened to our show long enough, we don't predict oil prices like long term. I don't know what the right number is. It's probably higher than what it was in January and February of this year, just because there's going to be more demand from countries that want to rebuild strategic reserves and countries that need to build them for the first time. But does that push, oil prices to like 100 or something? Probably not. So, what's a reasonable range to land in? Higher than 55, lower than 100? I know it's a broad range, but I don't know. I'm not going to pretend to be, an energy analyst who will predict like that exact pricing there. The only reason we were talking about oil prices and talking about risk to the upside previously was we could count barrels in the U.S. the same way that the president and his team could. And they said last week, yep, we were about 4 weeks away from running out of, commercial reserves in the U.S. This is the thing that we were seeing and talking about. When it comes to pricing oil in a non-emergency environment, I got no clue, same as the rest of us, Let's take a quick break. When we return, we've got a trivia question that we're going to do. And then the investor who scored a 900% win in the 2008 crisis has a new big short bet. We'll talk to you about this piece and what it means next.
Subscribe now to our YouTube page, where you'll find daily interviews and full shows of the Financial Exchange. We'll get you caught up on anything and everything you might have missed, right here on the Financial Exchange. Without the right estate plan, your family could face unnecessary costs in the future. The right trust may help your loved ones avoid probate and better protect family assets. Get Cushing & Dolan's new guide called Demystifying the Top 8 Estate Planning Trusts by calling 866-848-5699. That's 866-848-5699, or request it online at LegalExchangeShow.com. The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated. Every mile can make a difference for a Massachusetts veteran. The DAV 5K Boston returns to Castle Island on Saturday, November 7th for a family-friendly day of community, remembrance, and support. Whether you run the 5K, join the 1 mile walk, or make a donation, your participation helps further the mission of the Disabled American Veterans Department of Massachusetts. Honor those who served. Sign up today at dav5k.boston. That's dav5k.boston.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. One missed retirement deadline could cost you thousands of dollars. Our new guide, Understanding RMDs, breaks down the rules for required minimum distributions, including when you have to take them and what can happen if you get it wrong. This isn't just about taking money out of an account. Your RMDs may affect your tax bracket, the taxation of your Social Security, and even whether you pay higher Medicare premiums. This guide also covers common mistakes people make, like forgetting about old retirement accounts and mishandling inherited IRAs. If you have money in a retirement account, this is information you need to know. Call us right now at 800-393-4001 to get your free copy of Understanding RMDs. That's 800-393-4001, or request the guide online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
In a heartbeat, you could be the difference.
Marc collapsed from cardiac arrest.
9 out of 10 people who suffer cardiac arrest outside the hospital don't survive.
It took 30 minutes of chest compressions to finally feel a pulse.
Most of the time, it's because no one nearby performs CPR. But together, we can change that. Extraordinary things happen when people take action. A small step, a simple skill, a life-saving moment. HeartWalk brings communities together to create health and hope for every heartbeat. Every walker who joins HeartWalk, every dollar donated, means more people trained in CPR, more research, and more life-saving moments for everyone. Take the first step and register for your local HeartWalk. Extraordinary starts with you. Join HeartWalk today. Find your local HeartWalk at heartwalk.org.
Sometimes we know what's next. Other times, it's impossible to know. Life can change in an instant. Don't be caught standing by the next time someone's heart stops. Knowing CPR gives you the ability to act and takes you from bystander to lifesaver. CPR is a life-saving skill. Join the nation of lifesavers today by learning CPR at heart.org/nation. National support for CPR education provided by Elevance Health Foundation.
Here at the Massachusetts Department of Elementary and Secondary Education, we are committed to all students not only attending, but succeeding at school. Your presence is powerful. Share why you attend at doe.mass.edu.
Sponsored by the Massachusetts Department of Elementary and Secondary Education.
From market moves to retirement planning strategy, follow the Financial Exchange on Instagram and stay up to date on the business news of the day. This is the Financial Exchange Radio Network.
The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Register for this year's DAV 5K on Saturday, November 7th at Fort Independence on Castle Island. If you're not able to participate, you can still support our great American heroes by visiting dav5k.boston and making a donation today. Your participation helps provide vital services like free transportation to medical appointments and safe housing for single veterans and their families. Donate today at dav5k.boston. That's dav5k.boston. Time for trivia here on the Financial Exchange. And on this day, 1902, Goodfellow Dry Goods, eventually known as Target, was founded by George Dayton. Today, Target is the 11th largest retailer in the U.S. So our trivia question today, which Midwest city is the corporate home of Target? Once again, which Midwest city is the corporate home of Target? Be the fourth person today to text us at 617-362-1385 with the correct answer, along with the keyword trivia, and you win a Financial Exchange Show t-shirt. Once again, the fourth correct response to text us to the number 617-362-1385 with the correct answer, along with the keyword trivia, will win that t-shirt. See complete contest rules at financialexchangeshow.com.
Bloomberg with this headline. Investor who scored 900% win in 2008 crisis has a new big short bet. So there's a guy by the name of Lee Robinson. He's a hedge fund manager. And he's decided that he is taking positions in credit default swaps on insurance companies because he's nervous about private credit. And apparently, back in the financial crisis, he turned a $20 million position into $200 million with, quote, timely bets against the U.S. subprime sector. So, this piece, in terms of, you know, it being published and being newsworthy, this piece sucks. And here's the problem, is most people, aren't actually going to read the piece. They're going to look at the headline and be like, ooh, like that guy must know something, and then like blah, 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 let me figure out what I can do. Number two, most people don't have the ability or the authorization from their broker to buy credit default swaps and trade them. The reason why is because, if we're being entirely honest, most of us are too dumb to trade credit default swaps. Like, I am. Like, I realize that. I've never even touched one because I know I'm not smart enough to play in that ballgame. The third reason why I dislike this piece is because, okay, so you're telling us that, Lee Robinson is getting into these credit default swaps. Are you going to publish the piece before Lee tells us, hey, now I'm getting out of them? No, you're not. So, we don't know if he's getting into them for a week because he sees, a short-term pricing thing. We don't know if he wants to just ride this until, private credit just melts down entirely. We have none of this context at all. And so I think that broadly, whenever I see a piece like this that's like, oh, this investor who made money doing this is now doing that, I can't stand it because, A, it assumes that just because they made one good investment decision before that they're going to make another one. Second, it doesn't tell you anything about the timeline or what they're how they're actually trading it. And third, in this case, it's talking about an instrument that is completely inappropriate for 99.9% of investors to trade, and most can't even trade it because their broker won't allow them to anyways.
Yeah, I think most people agree that there are problems and will continue to be in private credit. That's proposition number one. I think we can all accept that.
Sure.
Proposition number two.
Which, by the way, still might be wrong.
Could be.
We don't know.
Could be. That seems to be the conventional wisdom.
Sure.
We know insurers, because they have to, hold a lot of fixed income. Unlike you and I and long-term investors, we can hold a lot of equities relative to bonds. Bonds for us are mostly insurance. Not for everybody, but for a long-term investor. Insurance companies think about their liabilities totally differently. They need fixed income to fund their liabilities because they're pretty predictable. So they might be 70% fixed income, the rest in real estate and equity. So insurance companies hold a lot of this stuff. Does it make sense to bet against, if you're bearish on private credit, does it make sense to bet against certain insurance companies? Well, that might follow. I don't know. How he's doing it isn't entirely clear. I don't know if he's using traded credit default swaps or if he's asking investment banks to make them for him.
Sure.
Like special contracts that nobody...
Right, which they will do. If you're a big enough customer, they'll do it
during
for
the
you.
financial crisis. That's how some of the more famous hedge fund managers made money. They didn't go out and buy something that somebody else, some other vehicle managed by somebody else. They asked an investment bank like Goldman to make one for them. They wanted to insure against very specific events. So it's not clear where he believes the weaknesses are and how precise his rifle shots are.
I also just, I got to read some of this other stuff just because it gets it, you're just not playing in the same ballpark as these guys, not even the same neighborhood, not even the same, planet. Elsewhere, Robinson launched a digital currency fund in 2014 that's gained significantly exception and made winning wagers on Lebanese sovereign debt and Fannie Mae junior preferred securities.
Yeah, those are real rifle shots. That's what I mean.
Right, this is someone who is plugged into everything he's doing. I don't know if this trade is or isn't going to work for him, but if you can't tell me what the Lebanese currency is, then you shouldn't be playing around with anything else that he's doing, is kind of where I land. Mark, I don't know what the Lebanese currency is.
No, I'm not going to look it up. I don't want to cheat, but, can
we make a guess?
Forgive me, but who cares?
Well
nothing's denominated.
I do now.
No, if I were Lebanese, I suppose I might.
Lebanese pound.
Is it? Okay.
Is it?
Yeah.
I was going to guess something like that, just given, early 20th century, British involvement in the region.
Excellent point.
But
nobody cares because it's not. Nobody transacts in it.
It was either that
globally.
or the franc. It was going to be one of those two. I think Algeria still uses the Algerian franc or whatever it is. So, I don't know. But in any case, if you see a piece about, hey, really smart guy or really random anyone person in finance had this good trade and here's their new one, you don't have to do what it's saying in there.
Sometimes they're. I don't think he is, but sometimes they're so to speak talking up their book to boost the value. I mean,
yes.
Managers are famous for doing this. They go on TV.
Of course,
they talk something up. They
That's
own
why
it.
CNBC
They disclose.
And Bloomberg exist.
Pretty much, yeah. Why else would you? Right. Yeah. I'm sorry, but you can't be too cynical about finance. That's absolutely true.
No, I mean, CNBC more than Bloomberg, I think. CNBC, half of it's just an infomercial for whatever hedge fund managers
it's very glossy,
on there.
CNBC.
Which is, it's fine, but you just got to realize what it is. Let's take a quick break here, and when we return, we've got a few things. Number one, we have an answer to the trivia question. Number two, we've got Wall Street Watch. And number three, we're talking about artificial intelligence and power. How are we going to pay for it? How are we going to build it? We'll discuss after this.
Bringing the latest financial news straight to your radio every day. It's the Financial Exchange on the Financial Exchange Radio Network.
Is it a stroke? Even if you're not sure, act fast and call 911. Signs can include face drooping on one side, arm weakness, speech difficulty, or not making sense when talking. Time is critical. A stroke requires immediate medical care, which starts as soon as the ambulance arrives. So if you see any sign of stroke, act fast and call 911. Visit mass.gov/stroke, sponsored by the Massachusetts Department of Public Health.
Our Senators Edward Markey and Elizabeth Warren and Representative James McGovern are standing up for radio listeners like us by supporting legislation to keep AM radio in cars. They know the value of local radio in times of emergency. Now it's time for Congress to finish the job and pass the AM Radio for Every Vehicle Act. Learn more at dependonam.com. This message furnished by the National Association of Broadcasters and this station.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. As you age, the IRS stops asking you to save for retirement and starts insisting that you take money out. Those withdrawals are called required minimum distributions, and if you don't take enough, you could face a penalty of up to 25% of the amount you were supposed to withdraw. If you wait too long to take the first distribution, you could end up with 2 taxable withdrawals in the same year, which might push you into a higher tax bracket or increase your Medicare premiums. Our new guide, Understanding RMDs, covers this issue and others to help you prepare for this important retirement deadline. Get yours today by calling 800-393-4001. That number again is 800-393-4001, or you can request the guide from our website, armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
In a heartbeat, you could be the difference.
Marc collapsed from cardiac arrest.
9 out of 10 people who suffer cardiac arrest outside the hospital don't survive.
It took 30 minutes of chest compressions to finally feel a pulse.
Most of the time, it's because no one nearby performs CPR. But together, we can change that. Extraordinary things happen when people take action. A small step, a simple skill, a life-saving moment. HeartWalk brings communities together to create health and hope for every heartbeat. Every walker who joins HeartWalk, every dollar donated, means more people trained in CPR, more research, and more life-saving moments for everyone. Take the first step and register for your local HeartWalk. Extraordinary starts with you. Join HeartWalk today. Find your local HeartWalk at heartwalk.org.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutzke from the law firm of Cushing & Dolan with your Financial Exchange quick tip of the day. And today, we're talking about your new guide, Todd, Demystifying the Top 7 Estate Planning Trusts. Now, do you lose control if you transfer your assets to an irrevocable trust in order to protect them from long-term care expenses?
Well, you know, that's great when you mention that irrevocable trust, but limit it to the kind of trust where you're protecting it from the cost of long-term care. Because as the guide says, there's 7 different kinds of trusts that we're trying to demystify. And there's also many kinds of irrevocable trusts out there, not just one type. So many people think there's just one type. But this particular type, where you're trying to protect it from the cost of long-term care expenses, the answer is no. You do not lose control over your assets. There's a whole spectrum of control with irrevocable trusts. And this one, you keep about 95% control. Like, you can live in your house, you can sell your house, you can buy another house, you can invest your money, you can manage your money, you can collect the income. Even the tax liability of these trusts are designed to be at your own rate. In other words, they are grantor trusts. You don't even pay any higher income taxes when you have this irrevocable trust. So this kind of trust, folks, you keep control, and you protect your assets from the cost of long-term care.
Call right now for your free copy of Cushing & Dolan's comprehensive guide titled Demystifying the Top 7 Estate Planning Trusts. It will help you determine what type of trust is right for you and your family. Call 866-848-5699. That's 866-848-5699. Or you can request it from LegalExchangeShow.com.
The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Armstrong do not endorse each other and are not affiliated. Time now for Wall Street Watch, tracking the stocks, the data, and the headlines driving markets so far today, right here on the Financial Exchange Radio Network.
Well, we're seeing more of a bounce back in tech after its recent pullback. Right now, the Dow is up over 1%. S&P 500 now up over 0.75%. NASDAQ also up 0.75%. Russell 2000 up 1.3%. 10-year Treasury down 8 basis points at 4.40%. And oil down over 4.5%, trading at $69 a barrel. In its first earnings report since it went public in May, Cerebras said it expects its operating margins to remain negative and under pressure through the end of the year, sending the stock down by 16%. Meanwhile, FedEx logged higher revenue in the previous quarter, but the shipping company's profit ticked lower. FedEx now down by 1%. Elsewhere, fast food burger chain Wendy's seeing its stock surge 25%, driven by meme stock retail investors after the company disclosed new management changes. Trading was actually halted in earlier trading. OpenAI unveiled its first custom AI chip called Jalapeno, developed in partnership with Broadcom. Broadcom is up by 1%. And after today's close, we'll see more tech earnings when chipmaker Micron Technology reports. Yesterday, the stock plunged 13% ahead of its earnings. It is currently down by over 1%. I'm Tucker Silva, and that is Wall Street Watch. And in the previous segment, we asked you the trivia question: which Midwest city is the corporate home of Target? That would be Minneapolis. And Dale in Bedford, Mass. is our winner today, taking home a Financial Exchange Show t-shirt. Congrats to Dale. We play trivia every day here on the Financial Exchange. See complete contest rules at financialexchangeshow.com.
Couple different pieces related to AI and power. One from CNBC titled "Tech Companies Would Have to Pay AI Data Center Energy Costs Under Bill Moving in Congress." Another one in the New York Times: "A solution to AI's growing power demand, homes." And so I really enjoy, Mark, how, so here's the common thread in this. The CNBC piece is talking about how the House Energy and Commerce Committee is debating a bill that will force data centers to basically account for extra costs related to building out transmission lines and stuff like that. This piece in the New York Times is talking about, hey, we want to, use, home energy solutions like, solar and batteries and, the ability for, utilities to, adjust your thermostat to manage the energy situation better. And I got to tell you, it seems like we want to do everything possible to make, to come up with a solution for this, except the one thing that you actually need to do, which is make it easier to build additional capacity to produce power. The reason why we're in the situation that we are in, and those of you who've listened to our show for a while, you know that we're based in the Northeast. The Northeast has had problems with high electricity costs since I've been alive. In general, like if you look at electricity costs in the Northeast, they're anywhere from like double to like 250% of what the rest of the country pays, aside from Hawaii and maybe California. The reason why is we don't allow for new facilities to be built, and we don't allow for easy transmission of either the fuels or the electricity into our region, and so we have really high electricity costs. It's a supply and demand issue. There is plenty of cheap natural gas all around the United States, but we don't allow the pipelines to be built to get it up to the New England region. Likewise, the lovely folks in Canada decided a few years back, maybe 15 years ago, hey, we'd love to send like some hydropower down through New Hampshire. Let's do it. And we basically said, no, thank you. We don't want the transmission lines because of, yada, yada, yada. So where I get to is you can talk about, these data centers are going to have to pay for their power. Oh, you're going to Guys, the problem stems from supply and demand. We're building data centers faster than we can build the infrastructure to support them, because if you talk to anyone who works in the electricity business, they'll tell you it takes anywhere from 6 to 10 years to go from start to finish on a project, and yet these data centers spool up in a year because the permitting is completely different. And if we would only deal with the root cause of the problem, which is that we don't build electrical capacity nearly quickly enough to deal with this, we could skip all of this stuff about, data centers are going to have to pay for this and that, and just build the capacity that's needed and call it a day.
How shall I put this? All this AI crap better be worth it.
Well, so this is the other piece, okay, is yes, all the AI crap better be worth it. And because otherwise, I will say, like, if you're going through all this stuff, like, here's the thing. The problems with our power grid predate AI, and they will continue beyond AI because, like...
But they're bringing it all to a head really quick. They're bringing them all to a head really quickly.
Right, that's fine. And like, maybe we'll actually deal with it then. Maybe we'll actually invest in our grid instead of just ignoring it.
By breaking it?
Sometimes you got to break a few eggs to make an omelet, Mark.
Yeah, but I need those eggs to, I don't know, live.
You do. But
have heat.
So I'm very much of two minds on this, which is, look, I don't know if AI is going to be worth it, but the reason why we're having this conversation isn't because of AI. The reason why we're having this conversation is because we don't do enough spending on our grid to begin with. And there are a number of different reasons for that. It's not sexy, it's not interesting. The way that regulated utilities work incentivize the local boards to keep those costs as low as possible and not invest in resilience or maintenance of those grids because, hey, the lower the cost, great ratepayers are happy then. But then when, in the Northeast, big winter storms come and we're out of power for 3 days, we complain, what? Well, do you want to pay more for, electricity? No. Well, then how are you going to, build more resilience in the grid? So I just think it's just like property taxes.
My gosh.
Everyone says, well, you can't raise my property taxes, but don't build anything new in my town either. And you can't have it both ways.
This isn't a constructive comment. I'm sorry, I'm not full of any insights in this segment.
No, sometimes we can just vent, Mark. It's fine.
Is that okay? Thanks.
Yes. Tucker, can we get like a drop for like
theme music?
Mark's vents or something like that? Not now. No, just for the future. Not like I don't expect you to make it now, but like we need a better
national debt has increased by 14-fold.
Okay.
In the past generation.
Yes.
2 to 28 or 30 trillion, 14, 15-fold.
Sure.
In the last 10 years alone, it's more than doubled. In the past few months, we've spent $500 billion when costs are properly accounted for on a fruitless conflict with Iran. What the hell are we doing as a society?
Should we talk about Social Security next?
No.
No?
Because I'm not sure I'd make it through that segment. The short-sightedness. Go ahead.
No,
I'm sorry. This is not constructive.
No. I've had the same conversation multiple times in the last couple
of
weeks on air.
What do you think history's going to say about us? Gee, they ran up $28 trillion in debt. Must have been to win a big war and advance the cause of liberty. Nope.
So the good news...
Okay, I'm listening.
...is that we're still here.
Okay.
I don't know, Mark.
Not the punchline I was...
Here's the deal.
Hoping for.
I've talked about this before. Look, you've got midterm elections coming up in 4 months now. No one's talking about Social Security. The system's going to break in 6 years unless we do anything about it. Even as it is, we'll probably get to 6 years out and just say, hey, you know what the solution is? Authorize more debt so we don't have to change anything.
Assuming we can.
The only things that we do to Social Security right now, if you look at the last 2 big changes to Social Security, it's basically been, hey, we want to pay more money out to people. Oh, well, that means you're going to collect more too, right? No, we're not going to do that. It's the exact opposite of, I've said this for a while. For better or for worse, in the 1980s and 90s, you could break with party dogma on anything economic because you had to. Reagan raised taxes, I think twice actually. Clinton cut spending. Bush raised taxes. These are opposite of, party dogma, but they did it because they said, hey, we had to do this because it was the best thing for the country and we'll get it done because we need to. If you look at how we've moved basically since the tech bubble burst, it's been the opposite. We just spend and we just cut taxes and we don't care about the deficit.
The tragedy, something I'll never be able to get over or forgive myself and others who voted during this period for, because I'm complicit. We're all complicit, I guess. I've been voting. And I voted for George W., for example.
I don't believe in individuals being complicit in the acts of their government.
And somebody,
like,
look, it's a democracy.
It's not like you
and
vote for everything that they
do
on a daily basis.
I'm being a little maybe generous here because, okay, fine. It's their fault, not ours. We have nothing to show for it, and that's a tragedy. History will judge us, I assume, pretty harshly. Nothing to show for the big deficits, I mean.
On a more uplifting note, though.
Let's move on.
The Armstrong Advisory Group tomorrow is hosting a retirement planning seminar talking about Social Security and Medicare. So as much as we can complain about it right now in the state of the programs, the fact is that when you retire, you still very likely rely on these programs for a portion of your income and for your health care. And so you want to have the right information available. Still a couple spots available. The seminar is taking place at the Marriott in Quincy, Massachusetts tomorrow at 5 p.m. And you can sign up by going to armstrongadvisory.com/events, or you can call 800-393-4001. Again, still a couple spaces available there. Tomorrow, 5 p.m. at the Quincy Marriott, 800-393-4001.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Let's take a quick break here. When we return, we'll do a little bit of stack roulette.
Stay informed and prepared for market changes and breaking business news. The Financial Exchange is live every day on YouTube. Tune in, subscribe, and keep up to date on all of our show's content on a daily basis. This is the Financial Exchange Radio Network.
This is Susan Powers from the Armstrong Advisory Group. When it comes to Social Security and Medicare, the decisions you make today can have a lasting impact on your retirement. There are key choices to consider, like when to claim, how spousal and survivor options work, and whether your Medicare coverage is aligned with your needs. Without a clear strategy, it's easy to overlook how taxes, income, and healthcare costs all connect. Join us for a complimentary educational seminar on Thursday, June 25th at 5 p.m. at the Marriott in Quincy. We'll help you understand your options and the decisions that come with them. That's Thursday, June 25th at 5 p.m. at the Marriott in Quincy. Reserve your seat today by calling 800-393-4001. That's 800-393-4001 or register online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Estate planning isn't just about writing a will. The right trust can help your family avoid probate, protect your home, reduce estate taxes, and even help shield assets from the cost of long-term care. That's why Cushing & Dolan created a new guide called Demystifying the Top 8 Estate Planning Trusts. Inside, you'll learn the difference between revocable and irrevocable trusts, why some trusts are designed to protect assets from a nursing home, and how certain trusts can keep your family's affairs private. The guide also explains some of the biggest mistakes families make, including creating trusts but never properly funding them. If you've been putting off estate planning, this guide is a great place to start. Call Cushing & Dolan today at 866-848-5699 to get your free copy. That's 866-848-5699 or request it online at legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
As a busy mom to 4 kids, my to-do list is full.
Trying to fit in exercise, eating right, and prioritizing self-care can feel next to impossible.
While we can't add more hours to the day, we do have a great resource to help.
Go Red for Women has easy tips, tools, and information to help you and your family live a healthier life.
So to all the moms, the aunts, the grandmothers, and amazing women out there doing it all,
visit goredforwomen.org/momlife today.
You take care of them, Go Red for Women will take care of you.
Our Senators Edward Markey and Elizabeth Warren and Representative Ayanna Pressley are standing up for radio listeners like us by supporting legislation to keep AM radio in cars. They know the value of local radio in times of emergency. Now it's time for Congress to finish the job and pass the AM Radio for Every Vehicle Act. Learn more at dependonam.com. This message furnished by the National Association of Broadcasters and this station.
Sometimes we know what's next. Other times, it's impossible to know. Life can change in an instant. Don't be caught standing by the next time someone's heart stops. Knowing CPR gives you the ability to act and takes you from bystander to lifesaver. CPR is a life-saving skill. Join the nation of lifesavers today by learning CPR at heart.org/nation. National support for CPR education provided by Elevance Health Foundation.
Hear the Financial Exchange every day from 11 to noon on SiriusXM's Business Radio Channel 132. Keep it here for the latest business and financial news and the trends on Wall Street. The Financial Exchange is now live on SiriusXM's Business Radio Channel 132. This is the Financial Exchange Radio Network.
Remember, you can watch the show live every day on our YouTube page. We'll have breaking business news, and all of our content is also archived. So if you want to go back and see a particular discussion, it's all there with the click of a button. Just search the Financial Exchange on YouTube and be sure to hit that subscribe button.
I'm going to kick things off for Stack Roulette with this piece from the New York Times. It's actually a Times exclusive. Mark Zuckerberg directed Meta to create a prediction markets app. So I got to tell you, the folks at Meta seem to be kind of flailing right now. And what's really... Again, here's the piece that I think is interesting to me. They've killed off the metaverse now because they said, okay, like there's nothing we can do with this. They've tried a couple different iterations of AI. So far, the market's not really biting on what they're doing. And now, Mark Zuckerberg has apparently personally ordered the creation of a prediction markets app because I guess the only thing Americans want to do is gamble on stuff, which is not really a great sign about us. But I appreciate Mark for at least recognizing which way the wind is blowing, which is towards like more dopamine. It's not really a good thing, but it is a thing, and so like it is what it is. The problem is like Meta has never figured out how to make money doing anything but selling ads. So I'm not sure they'll figure out how to make money doing this, but again, with Americans and gambling, you can generally figure out how to make money. The problem is this has nothing to do with like their core business or anything. I'm not sure that they would be any good at it. And the piece that I do keep coming back to on Meta is, hey, if you get rid of all these weird things that they're trying to do, they actually still have a really good core business that is fundamentally sound, strong, and just printing money hand over fist. It's just that they spend money like, just like they're like just on like a shopping spree trying to do all these different things, and none of them are really panning out for them in any way, and I'm not convinced this would be different.
Now, you don't hold him in particularly high esteem, Zuckerberg. Is that fair?
I just don't think he's a very... Look, here's the thing about any of these people. I don't actually... Like, none of us actually know them. I don't know anything about Mark Zuckerberg, but I do know that the company that he operates tends to be predatory, generally unethical, and kind of like a mess from that perspective. So I assume because he's running it that he's okay with these things, otherwise he would have done things differently. That's kind of how I feel. None of us actually know any of these CEOs. Like, we don't know if any of them are actually good, bad, or, neutral people.
But you can infer a lot, though. From...
I try to infer it, and generally I don't love how his company approaches things from, like, an ethical and moral perspective when it comes to the safety and security of their products. That's where I land.
Okay, thanks.
I do also like to make fun of him sometimes because it makes me feel better about myself.
His behavior's been a little bizarre. His opportunistic political change of stripes.
He's way smarter than I'll ever be. Like
he's a good coder. I mean, in one domain.
But again, you don't get to build a company like Meta by being dumb. Like, you have to be.
No one says he's dumb.
He's very smart, and also he knows how to play the game. Like, he knows how to play the game. Like, he's very good at what he does.
Fair enough. Fair enough.
I just happen to find, like, his company kind of objectionable in a number of different reasons, areas, things. What do you got for me?
Speaking of gambling, Wendy's, the restaurant chain, in the middle of a big turnaround, pretty well publicized. Share prices, or as of yesterday, down 70% over the past few years. Stock's been really beaten up, including this year. Today, at one point, it was up nearly 50%.
Wendy's.
You may ask why. What happened? Did they introduce some spectacular new variation on the
What'd they do?
Potato?
A new pickle?
A new a square pickle.
Yeah.
Yeah. No. Somebody
pickle.
Somebody posted. Well, you laugh.
It's
guys.
a squickle.
That's not as stupid as what happened today.
What happened today?
That concept. Stock was up at nearly 50% at one point today, off, of course, very deep lows, because somebody went on Reddit and posted like a single sentence on one of these meme stock boards.
Yeah.
Buy Wendy's before it's too late, or save Wendy's before it's too late. I guess there's a difference. That drove all of these meme traders into the stock, push it up nearly 50%. It's still up about 30% on the day. Speaking of gambling, the subject you raised, and a commentary on how crazy and inefficient in the very short term markets can be. Often moves mean nothing.
I always have a soft spot for Wendy's because my first business was Wendy's based. When I was in high school, I went to, for 3 years of high school, I went to a boarding school that I happened to live near, so I did not live there, actually. And no one was allowed to go to and from campus unless you didn't live there. And one day, I found a couple of my friends wanted, like, some burgers, so I went to Wendy's and I brought them back. The next day, a few more kids asked, and it got to the point where on, like, the 5th or 6th day, I would send someone to each of the dorms to take the orders from them. They'd bring the orders to me. I'd call it into Wendy's an hour in advance because it'd be like 150 cheeseburgers, like 70 Frosties, like, all this stuff. And then I would bring it back to campus, drop it off, pay all of my delivery people $20 so I didn't even have to leave the car. And I charged like 3x markup. The school got wind of it after, the 5th or 6th day because it got pretty big pretty quickly. Shut me down saying that I was profiteering. But I was just filling a niche. It was perfectly willing buyers of my goods at a price that I set. I didn't see the problem.
I don't see the problem at all.
They did. Let's take a quick break for the rest of the day. We'll see you back here tomorrow on the Financial Exchange.